and there's not enough dollars to fund both the repo markets and the federal government, that's two trains coming at each other at the same time, and there's gonna be a crash. Well, hello there, my friends. Raf here from the Endgame Investor with this week's Silver Report. And there's a lot to talk about. We're going to talk about a gold open interest delivery love triangle this month. Gold just went to delivery yesterday, and it looks like it's going to pull gold open interest down below 400,000 contracts, possibly. Not for sure, but we're getting pretty close. And if we go below 400,000 contracts, it'll be the first time since the end of the last bear market. I'll show you a chart that shows that these levels of open interest are bear market levels of open interest. Doesn't mean that gold's in a bear market, but it means that the sentiment is similar to a bear market in gold.
I'm sick of these constant bear attacks. It's like a freaking country bear jamboree around here.
And futures are getting less and less popular as the price rises. This is basically a sign that the physical markets are starting to take control of the pricing mechanism for gold, which is what we have been expecting all along. The Treasury is down $241 billion in 4 weeks. That gives it about 7 weeks of cash runway left before they have to raise the debt ceiling. It will be a little bit longer than that because income in the form of taxes will flow in the middle of June due to corporate tax day and other things. But we're getting down to the wire of when the X day is for the Treasury to raise the debt ceiling. And according to most estimates, it's around August. And of course, as I've been saying here on the Endgame Investor, there are no more dollars from which to raise debt for the Treasury to spend, since 80% of bank reserves are already being used by the repo markets. And the 10-year to 2-year yield curve spread is now at 51 basis points. The last recession occurred at about 99 basis points, the one before that at 51, and the one before that at 12. So we could be any time now at the next recession, according to the 10-year minus 2-year yield curve spread. Have no idea what I just said? Well,
you're like a child who wanders into the middle of a movie and wants to know.
Walter, what the fuck are you talking about?
That's why I'm about to explain everything in the slides ahead. This week's Silver Report is brought to you by the Endgame Investor on Substack. Click the link in the description below for my 3 times weekly updates on the gold and silver markets and the financial plumbing systems. And if you would like to support the Endgame Investor, then get your gold and silver with Miles Franklin. Link in the description below and mention the Endgame Investor. Or you can store your gold and silver in a dirty man's safe. Link in the description below and use the code ENDGAME10 at checkout for 10% off. Now with that out of the way, let's go to the slides. So quickly here, we have what I call a gold delivery open interest love triangle. Open interest right now is at about 411,298 contracts. How do I arrive at that number? Because the last reported number on the COMEX site, this is the CME on the left over here, is 426,571 contracts. There were 15,273 deliveries yesterday, which is going to take off of that open interest, and we have a total of 411,298. And we have what looks like another 5,000 or 6,000 contracts still open that will go to delivery. All we need is one little down day in open interest, which will probably follow a down day in the gold price, which has been happening. It's been very volatile out there in the gold market, and I think this is one of the reasons that futures are less liquid because of the Basel III regulations, which makes it more difficult for banks, for bullion banks, to act as market makers in this market. So does Basel III positively or negatively affect the gold price? No, it just makes it more volatile by contracting liquidity in the futures market, which appears to be what it's actually doing. Now, 400,000 in open interest. You can see open interest levels. I put a little thin red line at exactly the 400,000 mark in open interest. If you look in a magnifying glass, which I did, I zoomed in on this about 500% just to make sure I got the numbers right. This number in open interest has not occurred since the beginning of 2016, right over here at the edge of this oval. This was the end of the last gold bear market. You can see it corresponds to the price right here of gold at about 10.45.
We're here. We're queer. We don't want any more bears.
We're here. We're queer.
1,045, 1,046, maybe the low was. Whatever it was about 1050. And from there on, open interest has never reached 400,000 contracts again, but it looks like it is about to, except this time the open interest is going down and the price is going up, which means that the physical markets are taking control. And at some point, the futures market is going to wake up. And once it does, there's going to be a lot of speculative tailwinds for the gold price. It could bring it significantly higher very quickly. We've seen huge moves in the gold price on very small moves in open interest. A big move in open interest in the positive side, meaning open interest rising, will lead to huge moves in the gold space. You'll see it in the coming weeks and months, especially as we get closer to the end game and leading up to the final crash in the dollar. This is the Treasury's account at the Federal Reserve. When this goes to zero, they have to raise the debt ceiling. We can see from April 30th to May 28th, that's exactly 4 weeks, we have gone down in this account $241 billion. If you calculate that, there's about 7.5 weeks of cash left. It will probably be 9, 10, 11 weeks, something in that range, because cash will come in from the various corporate tax days from now until August. But this cash is going to drain. It's going to drain faster because they have to cut the bill size because they're already at the debt ceiling. And the debt ceiling.
Hurry! Really, hurry!
We'll see this go to zero, and once it does, they're going to have to raise money, but they can't raise any money because all the money is being used by the repo market. We're going to see that in this chart. This is the next chart I wanted to show. This is the repos to reserves ratio, how much bank reserves, what proportion of available bank reserves are being used by the repo markets. I go over this chart every few weeks just to update where we are, and we can see we're still on the same trajectory, heading up inexorably to that 83% repocalypse ratio mark over here. This is 2019 when there was a repo crash, a repocalypse, and repo rates went to about 10% overnight. We are headed there. We're going to get there within the next few weeks. You can see here that we're at 79%. The interesting thing about this number, 79%, is that it's outside of a month turn. The month turn is actually today. This is 2 days ago here, May 28th. This is always a day behind. So today, we will see the repo rates for May 29th, and then on Monday, we'll get the repo rates for May 30th, and those will be a spike. You'll see this spike probably above the 83% repocalypse ratio mark, but it has to stay there sustained for a few weeks in order to trigger something. But we're getting there, and we will get there, and there's not enough dollars to fund both the repo markets and the federal government. That's two trains coming at each other at the same time, and there's going to be a crash. Let's look briefly at the 10-year minus 2-year yield curve spread right now. It's at 51 basis points. We can see whenever it goes below zero and then goes back above zero, there is a recession, happens every time. This time we're at 51 basis points. The last time, we're going to start at 1990 and go into the more recent past. So we're going to start at the next slide here. We see the 10-year minus 2-year yield curve spread. In 1990, at what point did we come into a recession? At that shaded point, July 2nd, 1990, at 18 basis points. We're now at 51, so we're beyond that. So we could hit a recession anytime. We can see in February 28th, 2001, we hit exactly where we are now, 51 basis points by the time a recession was triggered at the shaded area here on February 28th, 2001. And most recently, 2008, we got all the way up to 99 basis points for all intents and purposes, 1% yield spread between the 10-year and the 2-year. So we do see here a trend. It's been going up every time that we hit a recession. First, we had 18 in 1990, then 51, and then 99, and now we're at 51 again. Maybe we have to get to 99 again. Maybe we have to get a little bit above that, but we are headed there. You can see on this chart, we're headed higher, and we will go higher still. Exactly how much time? I think it's going to coincide with the repocalypse, which is going to coincide with the repo to reserves ratio going above 83% on a sustained basis. Now, there's two more pieces of news I wanted to cover, and they are important. The first is Florida declares, thanks to Governor Ron DeSantis, that gold and silver are legal tender. What are the implications? How important is this? And second, an article from Wolf Richter that shows that the ECB does mark its gold to market. Now, I've been saying that if the Fed marks its gold to market, the dollar will crash. You could look at this article of Wolf Richter's and say, well, the ECB marked its gold to market and the market didn't crash. Well, that's a misunderstanding because the euro is really a dollar derivative. It is not a gold derivative. It's based on the dollar. It's the dollar that cannot mark its gold to market or the dollar will crash. And with that, the euro. So the euro can do whatever it wants. The ECB can do what it wants with regard to marking its gold to market. The Fed cannot. DeSantis signs bill recognizing gold, silver coins as legal tender in Florida. So there's something that doesn't matter and there's something that does matter about this. So it says here, there's a quote here from DeSantis. So you're going to be able to conduct transactions in these precious metals, DeSantis said at a news conference in Apopka. I guess that's a place in Florida. I wasn't familiar with it. But anyway, this is not true. You will not be able to conduct transactions in gold and silver, not because it will be illegal, but because it will violate Gresham's law. Gresham's law necessitates that people make transactions in the artificially overvalued monetary medium, which is the dollar itself, and it is not gold and silver. Gold and silver will only be used in transactions when the dollar is completely dead and cannot be used at all. But why is this important, even though it's not going to encourage actual transactions in gold and silver for other things? Because it's going to encourage transactions between dollars and gold and silver, and Florida can become a hub for gold transactions for coin shops, for people for companies like Miles Franklin. You can check the link in the description if you want to buy any gold and silver with them. So here's the quote that's important. Florida stands firmly for freedom, economic self-determination, and resistance to government overreach. But for too long, outdated regulations and unnecessary sales taxes have made it impractical for Floridians to enter the gold and silver market. So basically, what he's saying is that there will be no sales tax on gold and silver, so it will encourage saving in gold and silver, not spending, not exactly transacting in it, but it will encourage saving in gold and silver in Florida by eliminating the sales tax, and that will help the gold market. It might only apply to sales within Florida. I'm not sure. I'm not a tax expert. You have to talk to a tax lawyer about that or exactly how this law is structured, but this is good news for gold and silver. It doesn't mean that it's going to create a gold and silver economy in Florida just yet, but it will encourage savings in real money terms, which is a step in the right direction. And with that, this is Rafi of the Endgame Investor with this week's Silver Report for the Endgame Investor. And I'll see you guys next week.
We are going to die!